If you're thinking about downsizing your home in 2026, here are three questions to consider. If you can't answer them, you could be making a $100,000 mistake. Question 1. After agent fees, stamp duty, legals, and renovations, how much cash do you actually walk away with? Question 2. Can you put that cash into super and protect it from the age pension assets test? Question 3. Will your annual living costs actually go up or down after you move? Today, we're walking through a simple Excel calculator built specifically for Australian homeowners using 2026 data. By the end of this video, you'll be able to answer all three questions for your situation. The link to download this calculator is in the description below. Grab it now and follow along. The 2026 assumptions. Before diving in, let's cover the 2026 assumptions built into this model. Tax rules and concessions change, and if you're watching in 2025 or 2026, these are the numbers you need to know. First, stamp duty concessions for over 55s. Most states, New South Wales, Victoria, Queensland, and others, offer reduced stamp duty when you downsize into a new main residence. In this calculator, if you answer yes in cell C22, it automatically applies a concessional rate of just 1%. Without the concession, it uses the standard 3% estimate from cell C13. Second, downsizer super contributions. From July 2025 through 2026, eligible Australians aged 55 and over can contribute up to $300,000 from the sale of their home into super. That's per person, so a couple could put in $600,000. That limit is set in cell F22. Third, cost estimates. 2% is used for selling costs, covering agent commission, marketing, and legal fees. Ongoing council rates are estimated at about 0.3% of the property value. All of these can be adjusted, but they're realistic starting points for 2026. Inputs section. Explain the input section is in column C with cells colored yellow so you know exactly where to put your numbers. Cell C7, current property value. This is what you think you can sell for today. Be realistic. Check recent sales in your area. $850,000 is used as an example. Cell C8, mortgage outstanding. If you still owe money on your home, put it here. If it's paid off, put 0. Cell C9, selling costs. Default is 2%. In a competitive area or with a discount agent, you might adjust down to 1.5%. For a luxury property, it might be higher. Cell C12, new property purchase price. What are you planning to spend on your downsized home? $650,000 is the example. Cell C13, buying costs estimate. This is your stamp duty rate estimate before any concessions. 3% is used as a typical rate, but this varies by state. In the ACT, it's higher. In Queensland, it might be lower. Look up your state's actual rate and put it here. Cell C14, renovations and furnishings. This is often forgotten. When you downsize, new furniture or a quick renovation is common. $15,000 is the example. Cell C17, current super balance. This matters for the downsizer contribution. $400,000 is used. Cell C18, current age. You need to be 55 or over for the downsizer contribution. If you're 65 or over, there are additional pension considerations. Cell C21, is the new property your new main residence? This should be yes if you're buying your new home to live in. If it's an investment property, stamp duty rules change completely. Cell C22, do you qualify for the over 55 stamp duty concession? Answer yes if you're over 55 and buying your new main residence. This triggers the 1% concessional rate. Step 1. Net sale. Proceeds now to column F, where all the calculations happen. Step 1 starts in cell F7, net sale proceeds. First, selling costs are calculated in cell F7. The formula is equals C 7 times open parenthesis, C 9 divided by 100 close parenthesis. That's your property value multiplied by your selling cost percentage. In this example, $850,000 times 2% equals $17,000. Then in cell F8, net sale proceeds are calculated, equals C7 minus C8 minus F7, that's sale price minus mortgage minus selling costs. So $850,000 minus $0 mortgage minus $17,000 costs equals $833,000. That's the cash in your bank account on settlement day. Step 2, cost of new home. Step 2 is the cost of your new home starting in cell F11. Cell F11 is straightforward, equals C12. That's your purchase price, $650,000. Cell F14 is where the stamp duty calculation happens. The formula is equals IF open parenthesis, C22 equals, quote, yes, quote, comma, C12 times 0.01, comma, C12 open parenthesis, C13 divided by 100, close parenthesis, close parenthesis. If you answered yes in cell C22, qualifying for the over 55's concession, purchase price is multiplied by 1%. That's $6,500. If you answered no, the standard rate from cell C13, 3%, is used, which would be $19,500. That's a saving of $13,000 just by answering yes. That saving is confirmed in cell Y14, which calculates the stamp duty saved. Then in cell F15, total acquisition cost is calculated, equals F11 plus F14 plus C14. That's purchase price plus stamp duty plus renovations. In this example, $650,000 plus $6,500 plus $15,000 equals $671,500. Step 3, equity released. Step 3 answers the question, how much cash do you actually free up? Cell F18 calculates cash surplus from downsizing, equals F8 minus F15. That's net sale proceeds minus total new home cost. $833,000 minus $671,500 equals $161,500. This is tax-free cash. It's financial flexibility. It could fund a holiday, a car, investments, or, strategically, a super contribution. Step 4, super and retirement impact. Step 4 shows the retirement strategy potential. Cell F22 shows the maximum downsizer contribution for 2026, $300,000 per person. Cell F23 calculates the proposed contribution, equals MUN open parenthesis, F18 comma, F22 close parenthesis. This takes the smaller of your cash surplus, $161,500, and the maximum allowed, $300,000. So it recommends putting the entire $161,500 into super. Cell F24 shows the new super balance equals C17 plus F23. Existing $400,000 plus the $161,500 contribution equals $561,500. Why does this matter? Once that money is in super, specifically in the pension phase, it's generally exempt from Centrelink's assets test. That means you could potentially keep more of your age pension while still having access to the money. Step 5. Ongoing cost comparison. Step 5 reveals the trap that's often forgotten, ongoing costs. Cells F28 to F30 show typical current home expenses, council rates, $2,500, maintenance and insurance, $4,000 utilities or strata, $0, assuming a house with no body corporate. Cell F31 totals these, $6,500 per year. Now look at new home expenses in cells F33 to F35. Council rates equals C12 times 0.003, about $1,950, because the property value is lower. Maintenance and insurance, $2,500. Utility and strata, $3,000. This is significant. Moving into a unit or apartment usually means strata fees. Cell F36 totals these, $7,450 per year. Cell F37 shows the annual operating change equals F36 minus F31. That's plus $950 per year. Even with $161,500 in freed-up cash, annual living costs have gone up by nearly $1,000 due to strata fees. This is often overlooked when considering a low-maintenance apartment. The chart at the bottom shows current home versus new home costs side by side. The three key numbers that matter. Three cells deserve special attention. Number 1, cell F18, cash surplus. In this example, $161,500. This is your financial freedom number. Number 2, cell F23, proposed super contribution. Also $161,500. This is your wealth protection number. Putting this into super potentially shields it from the age pension assets test. Number 3, cell F37, annual operating change, plus $950. This is your lifestyle reality check. If this number is negative, you're saving money annually. If positive, like this example, it needs to be factored into your retirement budget. Centrelink and age pension implications. Look at cell I-20. There's an important note. The cash is accessible by Centrelink. If placed in super, pension phase, it is usually exempt. Here's what that means. If that $161,500 stays in a bank account, Centrelink sees it. Under the assets test, that money reduces your age pension entitlement. For a homeowner couple, every $1,000 over the threshold reduces the pension by $3 per fortnight. If it's placed into super, specifically into a super account in the retirement phase, it's generally exempt from the assets test. That means you could potentially keep more of your pension while still having access to the money through minimum annual withdrawals. There are rules. You need to be 65 or over to access the pension phase, and you must meet the downsizer contribution conditions. You or your spouse must have owned the home for at least 10 years, and it must be your main residence. For many retirees, this is the difference between a part pension and a full pension. How to use this for your situation. Here's how to apply this. Download the calculator using the link in the description. Put in your numbers. Then look at those three key cells, F18, F23, and F37. If the numbers surprise you, that's valuable information. If you're seriously considering downsizing, take this spreadsheet to a financial advisor. Ask, does this make sense for my retirement? Should I put the money into super? How does it affect my pension? One final note, stamp duty rules vary by state. In WA, the concessions are different. In the NT, it's another system entirely. Check your state's Revenue Office website for 2026 rates. If this was useful, hit the like button, subscribe for more Australian retirement planning videos, and comment below, are you thinking of downsizing? What's the biggest thing holding you back? Thanks for watching.